3 popular forex trading approaches. 1. Day trading. Day traders place multiple deals that may last from several minutes to several hours within a single day in an attempt to make the most of small market moves. Apart from getting quick results on the same day, another advantage of this approach is that you don't have to pay overnight fees, since your positions are not transferred to the next trading day. Some drawbacks of day trading may be relatively small outcomes and high risks of overtrading. Day traders heavily rely on technical analysis tools and often use stop-loss orders to manage risks. 2. Position trading. Position trading implies spotting a prevailing trend and holding a position for as long as the trend continues. Once the trend reaches its peak, a position trader exits a trade. Since position traders tend to focus on large-scale market movements over longer time frames, they largely rely on fundamentals. One of the complexities of this approach may be spotting the right entry and exit points. Position traders often use stop-loss or take-profit orders to manage risks. 3. Scalping. Scalping is aimed at identifying small price moves during very short time frames, from seconds to several minutes. Scalpers may place numerous trades, as many as hundreds, during a single day with the intention of receiving small, quick outcomes. Scalping is a very time-consuming approach that requires high concentration and fast decision-making skills due to its speedy nature. Since scalpers use extremely short time frames, they mostly rely on technical analysis tools rather than on fundamentals. To become a successful scalper, one should learn to spot the right entry points and employ a strict exit method, since there are also high risks involved. No matter which trading approach you choose, keep in mind that you should adopt and follow risk management techniques before entering a new trade. Have a pleasant trading experience.